Welcome to Perspectives Live. This is I'm the host, Larry Pruss, and we talk everything about the kind of the intersection of traditional finance and emerging fintech and technologies. Really pleased to have Jessica Willis. Is it Willis? Is that how you say it?
Willis.
Jessica Willis, CEO of is it gosh, I've already I want to say podcast, but Pocketnest, and you guys have a financial education wellness, and we're going to be talking about that today. I guess I should probably start with, since we are talking financial stuff, none of this is going to be considered, should not be considered financial advice. I am not a financial advisor for sure. Do your own homework with these things, but we will be talking about finance and how it impacts, different generations and different approaches for, like, imagine your clients are much the same as some of our clients, which are banks and credit unions, and what are they doing, and all of the things around that. Before we got started, we were talking about some of the demographic differences between like millennials and Gen Xers and baby boomers and silent generation. And I was trying to figure out like how many of them are there in America, and like if the numbers are right, who knows these days, but like I Googled or grokked it, and it was like 72 million millennials, 65 million Gen Xers, and then like 20 million silent generation and 76 million baby boomers. So like 96 million, and let's just call it 100 million people are of the age that in the next, I got to think of my parents. I hope they live forever, but like
Right.
obviously that's not going to happen. But like, probably in the next 3 to 6, 7 years,
Yeah.
a lot of those folks, just part of my life are going to pass away. And we know there is, like, I've heard crazy numbers, like lows of like 40 million, highs of like 70 million. I'm sorry, million, trillion with a T, 70
Yeah.
trillion, 40 to 70 trillion dollars of generational wealth that is going to transfer to the next generation. Assuming the healthcare doesn't eat up all of those costs in the final years, and I imagine it won't. And are the Gen Xers and all the millennials, are they ready for that wealth transfer? And clearly, from some of the statistics on your website, I'd say they probably aren't. I was surprised, and I think we posted earlier that like 98% of millennials are going to fire their parents' advisors upon inheritance. Like, okay, that's crazy. And then 67% of them get their financial advice from Facebook and Twitter. Also a little crazy. Not to say you can't get good advice from Twitter, but maybe it's a little questionable. So, like with all that as background, let's talk a little bit about you, because I could talk forever. How did you get started? You and I had a great conversation like
Couple
months
times.
ago, right? It was like, oh, we got to
Yeah.
get this going. We finally are. So, like, tell us the story of Pocketnest and your background, right? Because you actually are credentialed. I think you're like a certified financial planner, a certified wealth management, how about it, CFP and CFWP. So that's certified personal wealth advisor. Like, what's the difference?
Certified private wealth advisor
Private wealth
and
advisor.
certified financial planner.
Okay.
Yeah, Larry, we've had a couple conversations now. All have been invigorating, and I think you and I could probably nerd out for a couple hours about this stuff.
Sure.
If you go to the front of this recording, you'll catch some of that already. But yes, thank you. First off and foremost, thank you so much for having me. I'm happy to be here. I come from the wealth management world, so yes, I'm a certified financial planner, certified private wealth advisor. Those are basically two credentials through two organizations. I've co-managed $1 billion throughout my career in that wealth management space for over 300 families. But the story for Pocketnest is about 5 to 7 years ago now. I just started watching some pretty significant changes and just things I was noticing in the industry. The first was that robo-advisors came out. So those were algorithmic trading platforms. I'm I'm sure it's fine to share this, but I had a bit of a chip on my shoulder the first time I saw a flyer from one of the big robo-advisors come to my mail. It was 9 o'clock at night. I had very young kids, and I remember thinking, what is this robo-advisor? And I go online, and lo and behold, I'm interested in what they're doing. I've realized quickly that, they can do some of the investment piece that I'd been doing over my career, and I set up an account to kind of see how that goes. So that was one of the first like really interesting moments for me into fintech. The bigger moment on, or the bigger situation on why I started Pocketnest is I found myself in a situation over and over, Larry, and I know I shared this with you last time, where I was helping friends, and
Yeah.
I had this reputation that all you have to do is buy Jessica lunch or take her out for tea or go out for breakfast, and she'll tell you everything you need to know in an hour. And the questions my friends had were what I thought were pretty basic. It was, how much do we need in insurance? Do we need an estate plan? Not even the deep investment, do I buy stock A or stock B or mutual funds or ETFs? It was much more, help me sleep at night with the big stuff before I can even deal with what investment position to buy. And by the way, these friends of mine, this happens over and over and over, and these friends of mine are college educated. They're smart enough to know they don't know what they don't know, but they're coming to me, they're coming to Jessica over lunch instead of going to their credit union, or instead of going to their bank, or instead of going to mom and dad's advisor. And that's when I realized that advisor world, just wasn't set up to serve a lot of people. And so I realized, maybe I can take technology, put technology behind what we were doing as advisors to basically serve more people as like an on-ramp until they were ready to have that one-on-one conversation with their bank, with their advisor, with the wealth group at their credit union, or other professionals at their credit union. So that was kind of the aha moments and the why.
I'm smiling because I've got a bunch of friends who have always asked me stuff over the years too, and I almost tell them always like, just look at what everyone else is doing and do the opposite. But I've started to give them the reference of a YouTube video.
Mm.
This you'll probably cringe, but from the movie The Gambler, and it's Mark Wahlberg and John Goodman, and John Goodman is giving Mark Wahlberg some advice that he's like this degenerate gambler, and he's up
Mm.
like $1 million or whatever, and so John Goodman's like, all you do is like, and it's not safe for work language, so I won't play it here, but it's very funny, and it's like I've said it to my kids. I'm like, yeah, it kind of makes sense. Like,
Mm.
hey, like, you get a house over your head, you pay up the mortgage, you
Mm.
save a little money. Like it's really quite cute. But I love the background, and I've seen similar. And it is it's the basics, even the basics can be confusing, and
Yeah.
like a lot of people don't realize like how important it is to start early and how to kind of zero cost average and or dollar cost average, and so that's interesting. So now your platform is mostly like, I assume it resonates with digital native communities, right? So these people tend to be younger, they tend to be more savvy. I'm guessing if they're getting their advice from Twitter and Facebook, their platforms of choice are like Robinhood, Coinbase, Venmo, and Cash App. Like, am I wrong there?
I have a couple thoughts.
Yeah.
No, you're not wrong by any means. There's two really fascinating things I want to comment on. The first is, when one of the big robo-advisors rolled out in 2000, and it was probably 2008 to 2012, one of the biggest ones, their website was full. When you went to their website, you saw very young, ages 20 people working on investment. If you look now at the big ones, Betterment, Personal Capital, Wealthfront, Empower, just log those on. The images they're using are baby boomers, which is fascinating. So what I'm getting at, Larry, is what we found over the last, that's 20 years now, 10 to 20 years, is even though these fintech tools were created for the next generation, what we found in the robo space was that kids were coming home. They were saying, Mom, Dad, why are you paying your advisor, 1 to 3%? Just use these robo platforms, which, by the way, those robo platforms quickly then started hiring traditional advisors to have the one-on-one contact. So the model didn't work completely, and things have pivoted since then. But the point is, we create all these tech tools for the next generation, and our go-to is ages 25 to 45. But we are seeing those bookends be kind of deviate a little bit. We're seeing younger college age kind of click around in our platform. And then we're also seeing some baby boomers click around in our platform. But we created it for ages 25 to 45.
Yeah, I would be guilty of one of those baby boomers, or I think that would fit into, or maybe a little younger than that. But I you talk about robo-advisors, and I was thinking, I think there's an app called Autopilot, and they've got like the Nancy Pelosi tracker. Like,
Oh, really?
times I've been like, that's a robo-advisor that like I could get connected to. I think I would do well with that. But interesting. So you've kind of filled a gap. What drives your vision? What are some of your core principles that runs, kind of
Yeah.
in
So
that?
we and by the way, we license our software to banks and credit unions. So we are
Oh
not
yeah.
direct.
Yep.
Yep, not direct to consumer. What we found, and maybe I'll tack a little bit more on from the prior question you asked me. What we found in the very, very early days was, at the end of the day, people still wanted to work with a financial institution they trusted. So that's why we're seeing, I think, as an industry, a little bit of pushback on some of the let's call them the direct to consumer fintech brands. There's still a little bit of mistrust. They're doing a lot of great things, but there's also a little bit of prove it attitude. So when I think of your question, what vision, what motivates us, we want to equip the financial institutions who have the audience, they have the customers, they have the members, they have the clients they're trying to serve. We want to equip those financial institutions with our software to help them engage with that next generation. So that's kind of our vision as a company. Now, the softer stuff that I'm actually much more proud of is the company and the culture that we have in place. We just got quoted in Inc. magazine earlier this week on an article on culture, and the headline on our section is "What Actually Works." So when I think more vision and mission, it's much more about growing this company, growing this team, that if you treat people really, really well and you're really, really inspiring to one another, that sort of trickles down to the clients at the financial institutions, and then hopefully to our end users and our bigger communities as well.
That's awesome. And I mean, you mentioned trust from a financial institution standpoint, but that trust also applies to, you working with a credit union or you working with a financial institution. So, that, I think that's probably pretty important. Can you spend a second, talk a little bit about maybe I don't know if this dichotomy is not the right word, but like, there's trust, but there's also friction in some of the fintech solution providers, yeah, maybe they're getting a little bit more trusted. We saw some lack of trust with maybe the Synapse failure, but certainly there's been a big reduction in friction. Are you starting to see some credit unions and community banks start to really focus on eliminating the friction for investing? Because I imagine younger people invest a little differently than older
Oh,
people.
yeah.
Maybe they need to be encouraged a little differently. Maybe there's gamification. So maybe if you could talk a little bit about that.
Oh, yeah. Oh, yeah. I was going to ask if you meant friction from a sales standpoint or friction from an end user standpoint, and it sounds like the
And
latter.
yeah, more the end user. I mean, I'm sure there's both ends. There's friction, but from the end user, I think that's probably where one of the big
Yeah.
pain points is, right? That's
Yeah,
what
there the
go to Robinhood.
it's almost like anybody who has grown up using technology, and even down to the really, really young children, they get used to the user experience. They get used to the best practices of the best user experience, and then there is zero acceptance of user experience below that. And so when I think friction, I think it is table stakes now that user experience needs to be across the board stellar. There's no room for anything, the wheel that you spend 10 seconds waiting for the wheel for something to load, that you can't have that anymore. People are if something doesn't work within 3 or 4 seconds, they're gone. So yes, the friction, and I do think every financial institution knows that now, because even the people running those institutions are used to using technology, and they're getting frustrated when something doesn't load or something crashes. So it's table stakes. Everything has to work perfectly, which is very hard to build, for the record. But it's really important.
So, I mean, so you're white labeling for financial institutions. Fortunately, it sounds like most of them recognize that eliminating friction is a big issue. So there's not a cultural divide there where you're going, guys, we really need to make this thing work and seamless, and they're pushing back, be like,
Oh
oh,
yeah.
our users don't care about that. Or that's not the case. So that said, you provide to a bunch of different institutions, right? So credit unions, banks, benefit providers, wealth advisors. Can you talk a little bit about how does your platform integrate with those organizations to deliver financial education? Like,
Yeah.
how does that look
Yeah.
like?
So we do have we serve a couple different segments. So one primary segment is financial institutions, and then the other segment is employee wellness. Employee wellness is pretty cyclical depending on what's going on in the employment market. The financial institutions are definitely our bread and butter. They're the institutions we set out to help and to assist. And then within that financial institution space, yes, Larry, it's broker dealers. We've got some broker dealers as clients, some wealth advisors, credit unions, banks, and other fintech companies as well. They all sort of overlap or Venn diagram over one another, meaning the product we roll out for one really is 99% similar to the product we roll out for all of them. There might be some nuances in how we communicate to their communities, if we're saying client or
Yeah.
customer or member. And then the products that we're driving their community too might differ. Those products are, of course, typically the products owned by our customers. So if we're licensing to a credit union and we identify that their members need an auto loan, or to buy a new house, or they want to invest into the markets, we're saying, great, your credit union can provide that service. Click here, and then we're driving that lead back in house.
Well, that's awesome. So there's a feedback mechanism when you identify an appropriate product that someone might be needing to get it back to the credit union or the community bank.
Yeah, and it's huge. I don't know if I shared these numbers with you last time, Larry, but we're identifying over $3,000 per user in revenue back to the credit union. And that's done, remember, we're very, very, very proud to say that's done in a non-predatory sort of way. This is done in a non-salesy sort of way. This is done in a way that their member or their customer says, I have a goal to, buy a house, buy my first home. I don't know where to go from there. And we're not saying, okay, click here, purchase. We're saying, click here to talk to someone. Your credit union, your bank has those resources. Learn more. So we just see ourselves kind of driving those services that you provide back with what the customer's looking for.
So you're really establishing a relationship similar to, I mean, at a high level, what a customer service or a good member service rep that really knows the customer or the member does, but also almost like a wealth manager. So like, of the 1% that typically have that kind of relationship, it sounds to some degree like you're kind of filling in for some of that,
Oh,
right? Because
yeah.
you're educating, you're providing advice, you're giving them guidance, you're building up a relationship. So there's that trusted relationship, and you're also finding opportunities where you're like, oh, you're trying to save for kids in college. You can get a student loan for that. But here are the things you need to be careful about: student debt, and so you're building up a lot of
Yep.
trust, right?
Absolutely. And we're doing that. Yeah, you mentioned there's kind of the 1%. There's individuals working with wealth advisors. We are not trying to displace wealth advisors. We're trying to queue the leads up for them
Yep.
when the customer is in a financial position, an emotional position, to have that conversation with them.
And I would imagine, I'm guessing, but I would imagine most of them aren't Yeah, because they're at a stage in their life. Again, knowing that you do kind of go up the age limit in terms of who you're working with. But I'm guessing most of them probably don't have a lot to start off with now. But again,
Right,
our earlier point, they're gonna have a lot
right,
in 5, 10 years. And so you'd be in that perfect situation that
right.
leads to wealth management
And they
when
want to build that relationship. They want to build that relationship, not, this is strange to say, but they want to build that relationship first through technology. So you get the next generation, the 20 or 30-year-old, who doesn't want to go into mom and dad's branch, mom and dad's financial institution to talk once a quarter to build that relationship. They want to build the relationship first over technology and building the brand and understanding the logo and the services. And then when they have questions, then they want to get together and have the conversation. So it's a flipped model from what the baby boomers would do. But they want to build that relationship over good technology that, again, has to work perfectly first.
well, and it makes sense too, because at the end of the day, good technology reduces costs and provides efficiencies and those sorts of things. So it's just queuing them up for a better relationship. Makes sense. Um, okay, so one of the things I saw on your website was that you do leverage a couple of different things, like AI, but also behavioral science. And so maybe you can talk a little bit about that
Yeah.
and how does that help you tailor advice for users and makes for a good engagement?
Yeah, we're really, really, really proud of those two things. Our software is, even though it seems very straightforward and simple from the user standpoint, which is what we want, it's actually incredibly complex technology that we've built for the last 5 years. The behavioral tendencies, the behavioral profiling stuff is fascinating to me. I think it's one of the bigger opportunities we really haven't tapped into. But basically on 4 screens or 3 screens, the first 3 screens, we ask each person a couple questions about themselves. So if you've ever done a behavioral assessment or a DISC assessment, it's basically a traditional 4-quadrant model. It's our own proprietary model that we've built with help from professionals, but we're just saying pick words that resonate with you. 3 screens, do you feel organized, messy, stressed, calm, you like being with people, group work, all the typical stuff. And just with those 3 screens, we can identify what motivates each person within some some framework. This is obviously not a personality test. This is just how can we help our users get things done. And so in this proprietary mix, we let people know they're either a mover and shaker, a steady Eddie, a perfectionist, or a social butterfly. And you can kind of make some assumptions as I say those terms, what kind of relationships they might have with money. Do they want to keep up with the Joneses? What's motivating them to build good financial habits? And so we use that to help teach them. This isn't done in a secret way either. It's like, here's what we know about you. We could be wrong, but here's what you should be thinking about. So that's the behavioral tendencies piece. AI is fascinating, and Larry, we could spend hours and hours and hours and hours on that topic. AI is thrown around right now as it's a buzzword. There's a lot of software out there saying they're using AI. AI can mean everything and nothing. For us, we're really, really proud of the AI we have built. We just got this incredible patent in under 30 days for this piece. I'm sorry, in under 60 days for this piece of AI that we built. We just got notification of that last week, which was record time. It's usually years, but we're really, really, really proud of what we built there. And the AI engine that we have in the back end, it allows us to take various forms of input. So our content, what motivates the behavioral piece, what motivates each person, their financial situation, their goals, our own kind of algorithms in the back end, and then information they've told us. We're able to take those inputs to then give them a very customized experience of, okay, you want to save for college for your kids. Did you think about this, this, and this? And tailor the response in a way that is going to resonate well with them.
That's awesome. And with behavioral science too, I agree. I think too few organizations dive into that because like you just go to a menu and you see how many options you might have on a menu. And like behavioral science says, like if you've got too many options, people won't be
Yeah,
able to choose, right? They get caught up with the clutter. And I see that I see that all over the place. I'm like, hey, that's just simple behavioral science. You got to limit the number of
yeah,
options someone has so they can make a decision. Else they just get stuck again, analysis
yeah,
paralysis.
yeah,
So financial literacy can sometimes feel overwhelming dry. I don't actually. It's overwhelming dry. I find it fascinating, but I know a lot of people where it's kind of like dry, right? They're like, "Oh, I just want my money to grow, and I don't want to." Like my youngest is like that. She's like, I just want to make sure the money's there and it's growing. Like
sure.
he's not interested, but with my oldest, he's like, yeah, he wants to know all about it and stocks, and like he's like, Dad, did you buy Bitcoin? And like all of that. They're like two very different personalities, and it probably goes back to that personality test you're talking about. How do you make it resonate with those different
Yeah,
personalities? Are you doing any sort of like gamification
yeah,
here all the time? Is there any
yeah.
aspect of that? Okay.
Yeah, and when I say the behavioral piece is probably the one of the lowest tapped or the biggest opportunities we haven't really tapped into yet as a platform. That's exactly what you're getting at. Yes, we are trying to make financial education, planning, experience, whatever you want to call it, fun for everybody. And I absolutely believes it falls into that 4 quadrant model. And so there's different things we're doing. So gamification, yes, there's a to-do list. I am very motivated by a to-do list. I like to know what's on my list. I like to get it done and move on. We also give badges, right? So other people are motivated by getting badges. If you've ever used the Nike app, right? That can help people. We have a chart that shows how far along you are, what's completed, so you feel this dopamine each time you complete things. We'd use different verbiage around marketing, depending on what we think will help people get things done. So the high quick answer is yes, we are absolutely trying to do what resonates for each person, but I think there's still a lot more to go to.
So would you consider what you do supplemental to what a credit union or community bank is already doing around this sort of stuff? Or I kind of feel like it's probably really above and beyond what most of them are doing. Like, how would you look at that? Is it supplemental, or is it really a dramatic shift in terms of like engagement and getting people where they need to be?
Gosh,
I feel like it would be. I really feel it would be more like a dramatic shift because I'm just thinking again, my own experience, and again, I'm in a unique situation, but my financial or institutions outside of like my E-Trade, every once in a while I get someone calling me like, hey, do you want to have a wealth management conversation? And I'm like, no, I'm good. I manage my money. But like, growing up through all of it, I don't think I've ever had any of my financial institutions say
yeah,
any sort of conversation about money, like other than,
yeah,
hey, you've got a bill due or you've overdrawn your account or whatever
yeah,
like that.
yeah. I'm going to say both, Larry, because I do think it's dramatic and disruptive. I think historically, let's say, here's an easy answer. 5 and 10 years ago and before, what we're proposing is completely disruptive. So your bank would focus on banking transactions, your credit union, a little bit of the same. With technology, and with where the next generation is insisting that their financial institution be their one-stop financial stop partner. So that's why I say both, because I think from this point going forward, again, to use the term table stakes, banks and credit unions have to do financial, whatever you want to call it, education, planning. They need to be able to answer the phone when someone calls, when a member calls or a customer calls and says, I need help. I need help with my insurance. The response can't be, we don't do that here. The response doesn't need to be, I can do that for you right now, but they have to be able to answer every question as it relates to financial planning, because the biggest competition these institutions are going to face is someone going onto ChatGPT and asking that question. So we want the members, the customers, to go to the financial brand that they've been using and their parents have been using to get the help that they need.
If you had to pick an app that wasn't anything white label that you worked on with a bank or a credit union, but a fintech app that is already doing some of this well, and you can kind of point to this and say, hey, this company gets it. This is why you're seeing deposits or members or customers going over here for these sorts of services. Is there one like a Robin? I keep bringing Robinhood because that's one that always comes up. But like, who does this well and outside of a traditional financial institution?
Yeah, I think I'm gonna struggle giving you a specific name, but I can answer from a segmentation standpoint. Okay. I think there are some brilliant direct-to-consumer fintechs out there. Brilliant. I think the Robo-advisors that started that, again, I misjudged in the beginning. They have brilliantly figured out how to bring investment to the masses. Now, my pushback is, before you bring investment to the masses, let's make sure the masses have dealt with their high interest credit card debt and they have a savings account and, you know, they can put food on the table and they're not overmaxed on certain things and they're thinking about
they're not degenerate gamblers, right?
Exactly. So I think that's where they've missed the opportunity, is let's deal with personal finance first. So yeah, I think the robo-advisors, when I think of commoditized algorithmic trading platforms, have figured that piece out.
Do you think there's a financial institution out there, could be a client of yours, might not be, that is doing this really well today? Like, are there any big ones like a Bank of America or like a USAA? Do any of them?
I think they're all trying. They're all, I mean, we're on sales calls with all of with the global FIs. They all know they need to solve, how do I do more than banking for the next generation, efficiently and with scale without losing money when their parents pass away. They know the answer to that is technology. They know AI is involved. They're all looking at, do we build or buy? And they're looking at speed of market. And again, we have these conversations with them. It's speed to market and the cost of building versus buying. The credit unions, I think, there are a lot doing it very, very, very well. I'm going to say like mid plus to larger credit unions, they are asking the right questions. They have heads of innovation. They're probably the ones that I'm seeing are doing it best.
I'm guessing if you are calling on a prospect and it's a credit union, you're having a pretty good conversation with them.
Yeah. They know it's got to be done, and they've got tools, resources, and if they have people internally who can help evaluate the tools, they can get things done quickly.
So let's talk a little bit about, without defining the reasons why, because it's many, but we've seen a hollowing out of the middle class, right? Or at least it feels that way. It feels like there's a group of people who have a lot of wealth, and maybe it's always been this way, but it seems exasperating. A group of people that don't have any. And I think about even my kids, you know, they're okay. They've come from, you know, good family, and we do okay. But like even them, they're like, Dad, how am I ever going to afford a house? Like, how could I ever afford a house? And I struggle to sometimes answer that question. Or like, you know, you've got people now in the gig economy where they're working like 3 or 4 jobs. Like, it's not the traditional, like when I went to college and then I went and got a job and you're working like, you know, 8 to 5 or 8 to 6 or whatever that is. It's a very different environment for kids growing up. Yeah, I'd say kids, anyone younger than me. But yeah, younger folks growing up, like they've got to feel, I know they feel the stress in this. And how do you help them solve, like they've got student issues and they've got, like, how do you help them solve some of these things? How do you address some of them? Because some of it's a societal problem.
It is.
You can't, but some of it is educating them to go, all right, like we know that if you start young and you do a certain amount all the time and you do dollar cost average, like these are things that we know work, like generation after generation after generation. We know that putting money to some degree in the stock market works. But some of them are going to push back and go, yeah, but that's what my dad did. And I saw dad
Yeah,
lose a bunch of money in 2008.
right.
But like crypto is the thing. I'm doing crypto. Like, how do
Yeah.
you have a conversation with someone like that?
Yeah. Uh, I haven't read any research on this and I'm hesitant to say it in this forum, but I'm going to, and hopefully someone will send you guys some research that you can forward to me. Um, the big ticket. So first I'm thinking why the big ticket items are so much more expensive on a relative and absolute basis than it was when both of us were kids. So I'm 46. So the thought of like when my generation, when we were all going to get new homes and cars, they were 75 to 50% lower than they are now. Again, from both a relative and absolute basis, even when you look at it's not like we're all making twice as much as we were 15 years ago, but the homes, cars, it is just mind blowing. I feel like an old lady, like things are so expensive these days, but they are the big ticket items,
We really
college
are.
as well. And I think it started when this generation started coming out of school. A lot more people coming out of school with student debt than not coming out of school with student debt. So that's sort of one thing I haven't seen the research, but that seems to be a little bit of the why. Um, how I would coach them is the same way I coach my kids, which are 15, 13, and 9. Start, and you said it already, Larry, it's start early. You have to be intentional. You have to have conversations with your kids and the people in your life around personal finance, your spouse, your partner, and you can't put your head in the sand. And I think in our generation, people could kind of put their head in the sand and still end up financially okay. And that's not the case anymore. You can't just fall into bad credit. You can't just fall into a student debt. It's intentionality, and I think it's gonna get harder and harder for people to buy these big ticket items.
That's a great point because I mean, when I was growing up, my generation and my parents' generation, we never talked about money. I mean, and somehow or another, I missed the home ec class where they taught you how to balance your checkbook in high school. But like outside of that, there was no financial education or wellness. Like
Yeah,
you didn't know that you had to pay you found out about paying your credit card bills on time after you got $8,000 in debt and you had to have dad or mom bail you out. Like that's the kind of experience. It was like, oh yeah, I shouldn't have done that. Like, oh, you have
yeah,
to pay these things back on time. Oh, interest builds up over time. Like those are hard lessons that you don't want kids can't afford to have those hard
right,
lessons these days, right?
right.
Because it is very different. The houses are that much more expensive. So I totally resonate with what you were saying there.
Yeah,
Um, so we talked a little bit about trust before. Younger generations starting to trust fintechs and big tech brands over traditional banks. And I think sometimes that's a little overblown, right? Because I think to your point, if they could get the same technology through their local credit union or their community bank, and they've got a relationship there
yeah,
and trust them, like, the trust in the banking system has been built over 400, 500 years.
yep,
Yeah, we
yep.
had some 2008, we had some issues, and we've largely recovered from that. But fintechs are catching up to some degree. So how does Pocketnest position itself in this shifting landscape
Yeah.
of trust with users?
Yeah. Well, what's so interesting on that, and I don't have any of the stats in front of me, but the research shows, and the last time I looked at this was probably a year and a half ago, so I'm sure it's changed a bit. But what we saw is the next generation, however you want to define it, yes, they are interested in fintech. They are interested in these big direct to consumer tech brands and they are testing them out greatly, but they are leaving their big items, they are leaving their balances with the larger institutions. So yes, they're interested in the trading platform, but they're still going to keep the majority of, what have you over here. And so that was, I mean, when we started our company, it was research I had done. When I started the company, it was, okay, do we go direct to consumer or do we license to FIs, financial institutions? And I just kept seeing the evidence to license to financial institutions because of the trust, especially like you said, the credit union brands, you know, the bigger names, even the community banks. People want, at the end of the day, they want to know that they can pick up the phone and have a conversation with someone if they want to. That doesn't mean they're going to do it quickly. They, again, want to start the relationship in technology. But we find that by our software being white labeled to these institutions, we're helping, you know, those recognized, trusted brands just compete with some of the direct to consumer tech platforms.
Yeah, that makes a lot of sense because we did a bunch of studies a while ago looking at deposit outflows, and what we were seeing is that people do use their primary institution to get their direct deposit, right? But it becomes then a funding source for all the things that they can't do or want to do
Mm,
through their credit union, right? So like, hey, I want to buy crypto at Coinbase. Okay, I'm going to transfer it. So you start seeing
hmm,
$100 or $1,000 go out every month to Coinbase, and it is not coming back. And people are scratching their heads like, well, why are we losing 5% of our deposits? Oh, it's going to Coinbase, or oh, it's going to Robinhood. They're doing something different. Why is that? And why
hmm.
can't you do that? Like and some of that's changing, like some of that's just regulatory requirements. Banks and credit unions
Yeah.
have different regulatory structures and can't do some of these things. But we're now starting to see even that change with the regulators, with like, just yesterday, the OCC reaffirmed for banks that you can do crypto, you can custody, you can provide trading. The NCUA had said that for a long time, but like we're starting to see financial institutions go, oh, like let's win this back, these deposits
Mhm.
back. And so I do agree. They're
Hmm.
trusted as that central place where they keep their money. I'm not 100% convinced that they're trusted to do all the other things, but it sounds like the things you're doing from a financial wellness standpoint is building that level of
Yeah.
trust that they do stay with the credit
Yeah.
community.
Yeah. Yeah.
Um, so what are some of the biggest barriers that you see in getting millennials and Gen Xers engaged with financial planning, and how do you overcome them, right? Because I could see that being a major challenge. Like, where do you start?
Yeah. Um, Gosh, that's a hard one to answer. I've got a lot of thoughts. So, you know, there's the analogy, people would rather go to the dentist than, there's some statistic, than walk into their financial institution or deal with their personal finances. There's the whole sell, what is it? Sell Tylenol, not vitamins. I don't know if you've heard that one, right? It's like people don't want to deal with their personal finances. And if I could, I would put that entire sentence in quotes. I think we're seeing that change. So that whole don't put your head in the sand, I don't see the next generation doing that as much as I think I have seen some friends do it along the way. And again, to the earlier comment we said, I think you could do a little bit more of that when we were kids and end up okay from a financial standpoint. I think now this generation, and let's say, you know, millennials have been, they know, they grew up when mom and dad lost on
Yep.
paper money in 2008. They had student debt. They know they can't stick their heads in the sand. So I do think the next generation is at least more aware, and they're recognizing they don't know what they don't know. So that's the first thing. I don't think it's as much as hard of a battle as it may have been to just help people realize they need to deal with this. Secondly, what we've learned as a company is we've said, you know, you can't just, it's the whole, like, you can't build it and hope they come. If there's anybody watching this that's creating fintech that they're selling to financial institutions, you have got to create a war chest of marketing and engagement and rebrandable, white labelable assets. Because you can't just give a financial institution technology or sell them technology and say, here, good luck. An average 401k calculator tool has 1% adoption. That does not work. So like we're at about 20 or 30% across the board when someone follows our roadmap of, these are when you send out emails, these are the campaigns you have to push, this is what you push to social. That number's huge. We have to support the financial institutions with ongoing marketing campaigns in their brand to bring people into the fintech platform or the tool.
So it doesn't work without constant engagement.
Yeah. Yeah. Yeah,
Yeah.
absolutely.
And so your firm, your company does provide that level of engagement in addition to providing the tools and the tie-ins.
100%. And it has to be branded the right way too. That's also what we have found so fascinating is, you can't just send out an email saying, "Hey, did you know we have this software? Go use it." No, it's got to be. And by the way, Ashley Craven from my team runs our marketing, and she's brilliant at this. She knows you have to be engaging. You have to give with the next generation. You have to give them content. You have to give them something they want to click on. There has to be, we find it works with a little bit of humor, dad jokes, right? Like they have to start to enjoy and trust your brand to click on anything or to go into any of your tools and resources. And it has to be done over and over and over again because there's so many tools out there, we forget, right? So if we're not reminding our users, hey, come back in, it doesn't happen. So that piece is really important.
Well, I love that. I mean, your website is a good reflection of the different approach you take on this. I was looking at your about us page and the little bio that you give on everyone. Like I'll just read one of them.
Oh, good.
Tucker Steelman, programming puzzler, runner, and rocker. Tucker Steelman brings an additional 6+ years of experience to our development team as a systems developer with a gnarly programming chops in healthcare and employee wellness. He's the perfect fit for our financial, and it was going on and on. Like that it's just a different approach and it's cool. I think it resonates with younger people. It's not like the old like, hey, I got 25 years of financial
Yeah,
experiences. It's like what really makes us who we are. It's not necessarily our jobs. It's all of the stuff outside of it that makes us unique individuals. And that allows us to bring a certain lens to a company that sometimes people don't appreciate. So I appreciate that your company does have that approach.
good.
So when you connect to a company and you provide this sort of stuff, is this done through a portal? Like how do you
It's done in a lot of different ways. So if we can deploy the software a couple different ways, either inside of our software, we can deploy it as a freestanding app. And then this might be your question behind your question. With the financial institutions, we're typically doing an integration into their mobile banking experience with the SSO. So the idea is when you're in your digital banking experience, you're clicking on the tab up top that says financial wellness or education, and that's immediately taking that member or customer into the Pocketnest journey. They don't necessarily know because it's all rebranded to the FI.
um have maybe it's a matter of measurement and maybe you've seen it, but like I would imagine like you're engaging, you talked about marketing and how you have to constantly engage for these tools to work. So you've got a level of engagement with the member or the customer. But I also find that with financial products, particularly if they've got the technology, the financial institution has the technology to offer, whether it's robo trading app, self-directed investing, crypto, whatever it may be, that the members that are then using those financial tools are so much more engaged and so much more sticky than your average financial, like your average bank customer or a credit union member, to the extent that like, if you think about a mobile banking app, and this probably goes for the education piece as well. Like if I know, oh, I'm doing this gamification and I've got to do my one thing tonight to learn about whatever mortgages and to get my badge. So I'm going on there and doing that. That's a time where I'm engaged with that mobile banking app that I'm not, right?
Yeah,
And,
yeah,
and
yeah.
like with again, like I go back to crypto because we helped a financial institution launch a buy, sell, hold trade, and they've found that something like their members were like checking the app like 20 or 30 times a day,
Mm,
or before it was like once a week. And that gives them the opportunity to have conversations with them, cross sell other sorts of things, offer them advice. And again, you just build that trusted relationship because you've got eyeballs, you've got a relationship. They're
yeah,
all looking at that.
yeah.
And I imagine it's the same with financial wellness education is that you've got that relationship. They're on a lot more than they're not just checking their balance.
Right, right. Yeah, absolutely. I saw a stat once, and I can't remember the exact number, but it was in the 90s. some percent in the 90s of people log into their banking app just to check their balance.
Yeah.
That's fascinating. That's fascinating for a lot of reasons. So when you think of how often people are on their phones, the fact that they're just going to log into their bank to see their balance is interesting. That should, I don't know.
It should tell you something. It
It
should
tells
tell.
you a lot. It tells you a lot, right?
Again, I would willing to bet that if someone has a Robinhood, they're on it a bunch of times a day.
Yeah.
If they've got a Bank of America account, they're checking it once a week.
Yeah.
Like that's
Yeah.
so like there's some learnings in that, right?
Yeah. Yeah.
You did talk a little bit about employee benefits ecosystem, and I'm just wondering how that might be different. It seems related, but at the same time, it seems different.
Yeah.
I think you mentioned something that's kind of cyclical, and I'm like, oh, I want to remember to ask her, like, why is it
Sure.
cyclical? I'm sure there's a good reason,
Sure.
but so maybe can you talk about
Sure.
maybe why that's cyclical, but more importantly, like, what are you doing with that kind of employee benefits? Like, I
Yeah.
think I get it because I think we do something a little like that, but I don't know that we get a bunch of financial wellness. I'm sure there's like an app for that or something, but I'm not that engaged.
Yeah, it's fascinating. So hopefully I can do this short. The shorter story is when we started licensing to financial institutions. And when we were really new, we have 50 enterprise clients now, but when we were really new and only had a handful, of course, they were a little nervous. And so they'd say, well, what if we just roll this out to our employees first? Great. Yeah, that makes a ton of sense. Around the same time, so we launched in 2019, around the same time COVID happened. And what we saw was it very much became an employee market. I'm sure you remember this.
Yeah.
Employers were trying to support their employees as they weren't coming into the office. And so we started to get all these inbound calls from friends, from people who just found out what we were doing, from marketing. Hey, can we use your tool as an employee wellness tool to give our employees some comfort during COVID because people were worried about budgets and spending and everything. So we said, sure, sounds like we have a product here. Those two worlds came together, Larry, with the RIA market. So in the registered investment advisor market, a lot of them are advisors on 401ks.
Okay.
And those employers, those plan sponsors, the employers are asking their 401k provider, hey, can you do more than just my investments? And so the response we want to be is, yes, we can help you with everything. And Pocketnest can help those RIA clients serving 401ks who obviously serve employees, to do more financial planning and wellness beyond just that 401k investment piece.
Makes perfect sense. So being the CEO, what's the biggest lesson you've learned about leading a company that's trying to change people's approach to financial wellness?
Today there's a lesson a day, Larry. Let's
Yeah,
see.
I would imagine there is.
Um, I mean, the biggest lessons, the fascinating things, a couple of them have been one was the time we figured out, it would never make sense to go direct to consumer. Let's license our software to the very financial institutions who are trying to serve the people. That was a huge learning for us. We figured that out well before we launched, but it was
That's
still
great because a
interesting.
lot of companies don't learn that.
No,
They learn that lesson too late.
yeah,
Okay. And
yeah. The
even
other lesson
Dell.
The other really interesting lesson we learned early on, I find this fascinating. So we have 10 themes of financial planning. So building your net worth statement, dealing with your budget, dealing with investments, insurance, estate planning, income tax planning, college savings planning. What did I miss? Retirement. I think I missed one or two in there, but we've got these 10 themes and we've had that from the start. We've done a lot of research and surveys and focus groups to see which of those 10 themes are most important to people because there's marketing things to come out of that. What we have found time and time again is it's like 9 to 11% of people care about each of those 10 themes. So the point is, when we think about people dealing with their finances, you can't assume what that means. And so we would hear people say, oh, I'm all set with finances. I've got a 401k. period. Or, oh, I don't have to worry about my finances. I don't have student debt. Or I've got my estate plan. What they're missing, there's 10 themes, right? And we found that of the 50% of people said they're all set. They're doing everything they should be doing for their personal finances. When we drilled into it, we found that 90% of those 50% were missing at least one piece of personal finance. They didn't have their estate plans done. They needed insurance, but didn't have insurance. So the learning in there, I know I just said a lot, but it's that we can't just assume as financial professionals and financial institutions that people have their finances done, because they don't.
Yeah. And I imagine theme of the day would be diversification. Right? It's especially with what was it, like the Wonder Seven driving all of the stock market, and now like gold and Bitcoin's up. Like who would have thought? Like, but again, it helps to have a diversified portfolio if you're fortunate enough to be able to do that. One piece of advice that you could give to the millennials or Gen Xers, since you're targeting them, you're helping them. You're targeting the banks and credit unions, but you're helping them through this financial wellness. What would be one piece? I'm sure you can give them 10 pieces of advice, but what would be the one?
I always say just be intentional. So don't be scared. Just sit down and go through your finances. Do it in a way that works for you. If it's once a week, once a quarter, with your spouse, with your partner, by yourself, with your mom, with an advisor, with a financial professional, be intentional. Just start early and be intentional.
I love that. Be intentional is good advice for anybody, really is.
Yeah.
Okay, so guys, we're up. Our hour goes by fast. Let's see if there's any questions. If anyone in the audience wants to throw in a question, happy to take questions. And if not, I can ask you the question that, like, what's the question that no one asked that they should have asked? I don't see any questions in there.
I don't either.
Which usually means you did a good job.
Good.
By the way, what we're finding is that we're finding a lot of people. We used to have sometimes like 70 people would show up to these things. And now we're finding less people showing up live, but more people watching the videos afterwards. So our viewer, the amount of actual like eyeballs tend to be similar or has gone up. It's just different how people are consuming this sort of stuff these days. It is different. But so there is a question. Lou, I always count on Lou. Given market volatility, should I be in more cash? Lou, we already said we weren't giving financial advice here. But I will say, I always tell my kids, like, if you don't have cash, you can't take advantage when the market is really down. Like, you almost have to always have some money on the side to buy things when they're on the cheap. I always say it's like, it's blue light special. Everyone panics when the stock market down and they're like, oh my God, stock market's down. Like, should I get out? And I'm like, are you kidding me? You are fine buying plein air technologies at 107 or whatever. If it's at $99, doesn't that mean it's a sale? Like, but you got to have money set aside so you can purchase stuff when it's down. So then you get it to ride it all back up, but not financial advice.
Right.
Yeah, since you're actually the financial advisor, I guess.
I'm with you, Larry. I can't give financial advice, but I always say, don't try to time the market. So when I see given market volatility, should I'm like, nope. The answer is don't try to time anything, because it's not a one-way decision. It's a two-way decision. And sometimes it's a four-way decision if you're like
catching a knife while it's falling.
Yeah.
Right?
Yeah. But I think just in general, having a good, healthy amount of cash is a good thing to do. But I'm not going to tie those two statements together, Lou.
Probably even just for emergencies, right?
That's
always good advice for anyone. All right. Well, we appreciate everyone's participation today. Jessica, I thoroughly enjoyed this conversation. I've enjoyed all of our conversations. I'm sure we'll have some more of these in the future.
Perfect.
If someone is interested in reaching out to you, what's the best way to get a hold of you?
Yes. So really on our website, pocketnest.com, you can schedule time with any of us on our team. There's lots of information to see if it's a fit for you or not, but that's the best way to do it. And I'm all over LinkedIn. So of course you can find me on LinkedIn too, Jessica Willis.
Did see a question. Gretchen Bartholomew had a question. Gretchen sits in on a lot of these, and thank you, Gretchen. May have missed this. Is there a behavior tracking reports on the engagement of the app?
Yes, yes. So with all of our clients, we give them reports on a monthly basis of what activity looks like. And then we have a portal where someone, our FI clients can go log in to see, all the data. So yes and yes.
Awesome.
Perfect.
All right.
Thank
Well,
you, Larry.
yeah, thank you. This has been a pleasure. And with that, want to thank everyone for their time and look forward to our next one, which will be in a few weeks. And we'll be sending out a note on the date on that.
Perfect. Thank you so much, Larry. Appreciate it. Thank you, Victoria.
Take care. Bye-bye.
Bye-bye.